I feel compelled to start this episode with a confession. I don't normally pay much attention to Treasury bond auctions, but they've recently become a focal point for markets. Some even think that weakness in recent auctions is sending a troubling signal about U.S. government debt. So what's behind those concerns, and do they have merit?
Where's the demand coming from to satisfy all of this supply? And how much does the yield curve need to reprice in order to effectively accommodate the issuance needs of Treasury?
I'm Allison Nathan, and this is Goldman Sachs Exchanges. Today, I'm sitting down with Johnny Fine, who heads up our investment grade business in our investment banking business, and Alec Phillips, our chief U.S. political economist in Goldman Sachs Research. Johnny, Alec, welcome.
Thank you for having us.
Thank you.
Johnny, let's start at a really basic level here. For those of us like me that don't live and breathe Treasury auctions, help us understand how they work.
Well, first of all, I can't believe you don't live and breathe them every single day. I mean, it's the most fun thing that we could spend time talking about. But let me try and break it down for you. Well, look, firstly, the Treasury auctions off a lot of securities in any one given year. Some of them weekly, some of them monthly, some of them quarterly. There's a lot of them. They're telegraphed well in advance. As an example, there's one today. It's probably happened by now, but I think $70 billion of 5-year notes being auctioned by Treasury. And the way these get auctioned is in what's called a Dutch auction format, which basically means that participants submit a yield in which they're willing to buy a certain amount of the treasuries that are being auctioned. And what happens is that Treasury reviews all of those bids, and then it figures out what's the highest yield that they need to sell those securities at so that the auction ultimately clears. That's how it works in practice. Obviously, what Treasury is looking for is a lot of demand, and therefore the best price at which they can auction those securities, and markets focused on all the data that comes out after that.
So the lower the demand for these securities, the higher the yields, the more you have to compensate the participants.
That's correct. There's two elements of the auction itself that really the market focuses on when evaluating the quality of the auction itself. One is the bid to cover ratio. That's simply the amount of demand divided by the amount of supply. So in a $70 billion auction, if there's $140 billion of supply, that's a 2 times bid to cover ratio. The second element is the tail. And the tail is the number of basis points at which the auction clears at relative to the yield at which the auction was expected to clear at, driven by the futures market. In a bad auction, there's a positive tail. So, for example, there was a Treasury auction earlier on this month that cleared with a 3 basis point tail. Generally not viewed as a good thing because effectively the market demanded a higher yield for those securities to clear than had originally been anticipated.
Right. And just to be clear, there's a demand side and a supply side. So on the one side, how much do investors want to own these securities? And on the other side, how much supply of them is there? So $70 billion, the auction that is occurring today, it's a large size.
That's a big one. Yep, that's a big one. Now, to be clear, if the markets are efficient, and we know that Treasury communicates on a very regular basis, they have quarterly refunding announcements, for example, the Treasury will tell us exactly how many securities they need to issue in any one given period. So if markets are efficient, they should embed all of that issuance in the price of securities going into these auctions. Now, markets aren't always 100% efficient, and that's why these tails exist. But ultimately, the supply and demand intersects on auction day, but it's very well telegraphed. No one's ever surprised by the Treasury auction that's announced on any one given day.
Right. But on average, the supply side or the size of these auctions has been growing because we have to fund fiscal deficits. I mean, is that really how to think about it? We have a lot of spending that we need to finance.
That's correct. Exactly. So Treasury has to issue more. We're seeing these very, very large amounts having to clear through the market. And as a function of that, there's more attention from people like you on how these auctions are faring. So people are becoming much more familiar with what bid to cover ratios are. People are becoming more familiar with what tails are. And also there's one third element as well, which is in the ultimate makeup of who purchases the bonds and notes. There are 24 primary dealers in the United States. All of those primary dealers, Goldman Sachs included, are required to bid in auctions. Think of the primary dealer bid as effectively a backstop to all of the other external parties that otherwise might want to own treasuries. If the primary dealers end up having a lot of those securities allotted to them, that's generally viewed as a bad thing, because that means that the rest of the external population of Treasury buyers, insurance companies, mutual funds, pension funds, depository institutions, individuals, international investors, so on and so forth, it basically means that they haven't shown up to the party to the extent that Treasury would like.
So we've talked about the supply and demand dynamics at these Treasury auctions. We've actually seen long-dated rates, 10-year Treasuries repricing substantially higher. Is that a function of this supply and demand, or there's been so much focus on the Fed's trajectory from here? We've pushed back expectations of when Fed cuts will start. So what's really driving that repricing that we've seen recently?
So the short answer, I think, is that it's much more Fed than it is Treasury supply. But I'm going to compare and contrast the environment today to that which existed in October. In October of last year, the 10-year note hit 5%. And a significant component of that move and run up to 5% was driven by fears of supply, fears of auctions. It's what everyone was talking about at that particular moment in time. That went away pretty quickly as I think the market really started to take the view that inflation was under control. There's going to be a ton of rate cuts in 2024. We don't have to worry about this anymore. And in fact, as you'll recall, beginning of the year, we had almost 7 rate cuts priced into Fed funds futures. So what's happened since the beginning of the year, maybe most importantly insofar as term yields are concerned? I would argue the most important thing has been the repricing of the terminal rate, i.e. that is, where does the market now predict that the Fed will cut to, at which point rates will remain stable? Again, Fed funds today, 5.25%, 5.5%. The terminal rate expected, kind of call it a couple years forward at the beginning of the year, was around 3.1%. That terminal rate today is 3.8%, 70 basis points higher. What have 10-year yields done over that same period? They're 70 basis points higher. Though that, to me, would indicate that 10-year yields are where they're at today as a function of the move in terminal rates, as opposed to necessarily the sheer volume of supply that Treasury is going to have to auction.
Right. And the market coming around to this view, higher for longer.
Yes, absolutely.
So as you just said, these happen all the time, but there seems to be a lot of concern around them. And we've discussed that these auctions are larger than potentially on average they have been in the past. Is that the main concern, or what is the main concern?
Yeah, that's the main concern, is that where's the demand coming from to satisfy all of this supply, and how much does the yield curve need to reprice in order to effectively accommodate the issuance needs of Treasury? And then obviously the corollary to that is that when you look at 10-year yields where they're at today, is that are there a certain number of basis points, and think of those as what contributes to mortgage interest rates, for example, are there a certain number of basis points included in there that is solely as a result from the sheer amount of supply that the US government needs to issue?
Alec, let me turn to you. You're our chief U.S. political economist, which means you spend your days thinking about how the government and the economy interact. We just heard the market perspective. Now let's talk about the political perspective. Is this something that politicians and government officials are worried about?
I think maybe slightly, but not that much more than before. And I think the question is, what exactly should they be worried about? So you have obviously an elevated debt level in the sense of debt as a share of the economy, debt to GDP. But if you look back at what we had post-acute COVID, so say at the start of 2021, the debt levels basically remained roughly the same since then. How can that be when the federal government ran a cumulative deficit of around $7 trillion over that period? And the answer is that you had low interest rates, and you also had a substantial increase in inflation that inflated away a lot of the existing debt. And so now you have potentially politicians coming in next year post-election, and the question will be for them, what should they be worried about? They can't really worry about the level of debt because it is what it is. There's nothing they can do about that. They can't really focus on the interest rate because they don't control it. So the only thing they can really focus on is the deficit itself. But there, it's unclear that there's any real political benefit to doing that. If one looks at the polling question that Gallup has asked for a long time, essentially, what is the most important problem in the country? You have right now 2% of respondents saying that the deficit or the federal budget is the most important problem. And you compare that with back in the early 1990s, around 1/4 of the public. And even more recently, post-financial crisis, 15 to 20% of the public. And so I think it's just not as much of a political focus as it once was.
Interesting. So why is there so much less concern about it today?
So I think part of it is that we've now been through this a couple of times. So I remember starting at Goldman almost 25 years ago when the concern in the fixed income markets was that the Treasury was going to pay off all of its debt and there would be no benchmark interest rate anymore. And so now we have come a long way. We've seen multiple situations where the debt level has jumped by 20 or 30 percentage points of GDP quickly. And yet here we are still, muddling along. And so I think part of it is just the fact that people have seen this story before and are less worried having already seen it. I think part of it is also the fact that there's just not a political emphasis on it. So you look back to the early 90s when you had such a fiscal focus. At that point, remember, you had Ross Perot running in the 1992 presidential election on a primarily fiscal platform that was generating a lot of attention. More recently, during the post-financial crisis period, you had Mitt Romney and Paul Ryan running, talking about Medicare reform and Social Security reform. Now, both candidates are emphasizing essentially that they won't cut Medicare or Social Security, and more generally, not talking about fiscal issues. So I think we're just in a different environment than we were back then.
Right. Both candidates, as this U.S. election approaches, neither one, just keying off of your comments as well, Al, neither one are running on a platform of fiscal restraint. It's just not a key issue. So you don't expect that to change.
So I have been a little bit surprised at the lack of fiscal discussion in the presidential election, not so much because the debt level demands it or because it should happen as a result of the longer term fiscal challenges, but more specifically because we have a big fiscal event coming up next year, which is the expiration of all of the personal tax cuts enacted in 2017. And so the election result will determine how that's handled. I think our view is that you'll have some of that and probably a lot of it extended under any scenario, but different scenarios will result in different outcomes. And so I've been a little bit surprised that we haven't heard more about that. With that said, I think the main distinction from the election in terms of fiscal policy outcomes isn't necessarily Trump versus Biden. I mean, those two things would be different. But the main distinction is, do you have one party controlling everything, or do you have divided government of some kind?
So what does that difference really mean?
In a scenario where one party controls everything, so the House, the Senate, the White House, you typically end up with major fiscal legislation passing. And that's in part just because it's one of the most important things that the government does, but it's also in part because there is a lower threshold to pass fiscal legislation in the Senate in particular than to pass any other kind of legislation. And so even if with a 50-50 split and the vice president's breaking the tie, or 51-49 in the Senate, similar margins in the House, even with that kind of a narrowly divided outcome, you probably would still see pretty big fiscal legislation pass. So in the case of an all-Republican scenario, that probably means extending all of the expiring tax cuts, plus probably a little bit more on top of that in terms of tax cuts. And actually probably also slightly greater spending growth than what we have today under divided government. And under a Democratic scenario, if you look as an example at the president's most recent budget, you have a spending boost of a little bit more than 1% of GDP, a tax increase of a similar size. I think probably all else equal, you would have a slight increase in the deficit, though my guess is between the two scenarios, probably a little bit more of an increase on the Republican side. But the main thing is that in those scenarios, they can essentially do what they want to do, whereas under a divided government scenario, it just becomes very difficult to do very much. And because you have some fiscal restraint built into the law, so as an example, tax cuts are set to expire, you have spending caps in place, et cetera, doing nothing actually, surprisingly, probably results in a slightly smaller deficit than the other scenarios.
Interesting. But we're talking around the edges here, if I understand correctly, in that scenario.
Well, I mean, I think the big change would be if we saw some kind of reform to the major entitlement programs, so Medicare, Social Security, or some commitment to raise net taxes for purposes of deficit reduction. And right now, nobody is talking about any of that. As I mentioned, neither party is really talking about any major entitlement changes. And on the tax side, the tax discussion is usually couched in terms of how do we fund the new things that we want to spend money on.
Right. So that all seems pretty far. Johnny, when you speak to the leaders of companies who are raising money in the debt markets or are considering doing that, how are they viewing all of this?
So they're obviously looking at what the end result is of intersection of monetary policy and treasury financing, and that intersection means higher yields. We have very tight credit spreads right now. So almost everyone that I speak to, they love the spread environment. They don't particularly like the yield environment. But at the same time, I do think we've moved into a camp where the majority of clients that we speak to are just making peace with the higher for longer regime and therefore more elevated financing costs as a result. And you kind of think about what the behavior was in the first quarter of the year from a financing perspective. The first quarter in IG, investment grade financing markets in the US, was the busiest quarter that we've ever seen. Now, a lot of that was driven by what I think is liquidity risk management, knowing there's an election at the back end of the year. A lot of companies looked at the market and said, I've got financing to do. If I've got it to do at some point this year, let's go ahead and do it and not roll the dice and see what things look like in October and November. And history will tell you and data will tell you that's probably a good decision. And so that was a significant driver of activity. Look, companies, they're refinancing the debt that they have coming due. There's more limited expansion of their debt portfolios because the marginal cost of debt is that gets allocated to capital expenditure products or M&A, makes it harder to hurdle in a higher interest rate environment. Really, the only entity that's really incurring significantly larger amounts of marginal debt is the US government. And I would say a lot of clients that I speak to are kind of scratching their head a little bit at that behavior.
Right. So what are you watching in the markets and the economy, Johnny, Alec, that would make you more or less concerned about the supply-demand balance in treasuries?
Well, I'm going to answer it slightly differently because I don't think, look, at the end of the day, we'll get moments in time where people will be concerned about deficit financing and treasury issuance, and things will have a long tail in auctions and so on, and people will get concerned, and that will ebb and flow. I don't think we're going to get in the near term to a significant market correction as a function of this. What I am looking at, if I kind of think about the things that are out there that are worth following and spending some time focusing on, obviously employment's held up really well. Corporate earnings have held up really well. The US consumer has held up really well also, demonstrating, I think, pretty darn good resilience in the face of higher interest rates, or maybe an insensitivity to higher interest rates. Now, that can't last forever, and at some point it will bite. I'm looking at the state of health of the US consumer, and the indicators that I'll look at there generally come from bank earnings. We've seen a growth in consumer credit. We now have consumer credit above that which it was prior to COVID. The affordability is pretty good because wage prices have grown nicely, but that can change quickly. In a high yield environment, like the market, both on the corporate side as well as the consumer side, I think is quite highly levered now. And so as this starts to bite, I think it could bite fairly quickly and then create an environment where the Fed has to take corrective action pretty dramatically.
And Alec, what are you watching? You laid out a pretty concerning fiscal trajectory. What are you most focused on ahead?
One thing would be, obviously, as we get closer to the election, whether we see either candidate propose substantial new fiscal measures that actually would expand the deficit. It's been in some ways a little bit surprising that if you look at what both of them have talked about, there hasn't been more of a promise of doing something that would have negative fiscal implications. I mean, the other sort of along the lines of what Johnny was saying is if one wanted something to worry about beyond what we were just talking about on the fiscal side, consider that most of the debt that gets added to the U.S. debt burden gets added during or shortly after recessions. So if you take those periods out of the history of the last, several decades, you wouldn't really have much of an increase in the debt load. And that's the case again now, right? Where you basically saw a jump of around 20 percentage points during 2020, during sort of peak COVID. And then after that, sort of flat. And so, I think the big question for the fiscal side ultimately is actually, when does the next recession occur? What is the fiscal response to that? And do we end up adding another, call it 20 to 25% of GDP to the debt load as we did in the last two recessions?
So what I'm taking away from both of you is that the fiscal trajectory is no doubt concerning, but I like the way you put it, Johnny, that a sharp market correction is unlikely to be the result of any issue in the debt auctions per se, but that the biggest concern to really watch is ultimately the economy, the consumer, and the broader economy. And, if we have a recession, there'll be a lot more to talk about.
Yeah, I'd agree with that. But I'd also say there'll be bumps along the road. Like, there will be times where we likely have an auction, it has a big tail, market doesn't like it, we get a sell-off, a lot of headlines, a lot of focus, a lot of attention to it. I think it'll be short-lived, but those are the kinds of bumps in the road that I'd expect that we sustain.
Johnny, Alec, thanks so much for joining us.
Thank you for having us.
Thank you.
This episode of Goldman Sachs Exchanges was recorded on Wednesday, April 24th, 2024. I'm your host, Allison Nathan. If you enjoyed this show, we hope you subscribe on your platform of choice and tune in next week for another episode. And if you want more insights from Goldman Sachs, make sure to visit gs.com and sign up for Briefings, a weekly newsletter from Goldman Sachs about trends spanning markets, industries, and the global economy. The opinions and views expressed in this program may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Each name of a third-party organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. The content of this program does not constitute a recommendation from any Goldman Sachs entity to the recipient and is provided for informational purposes only. Goldman Sachs is not providing any financial, economic, legal, investment, accounting, or tax advice through this program or to its recipient. Certain information contained in this program constitutes forward-looking statements, and there is no guarantee that these results will be achieved. Goldman Sachs has no obligation to provide updates or changes to the information in this program. Past performance does not guarantee future results, which may vary. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program, and any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed.